Good afternoon, everyone, and welcome to today's Professional Advisor Working Lunch, brought to you with our partner, Baillie Gifford. I'm Katrina Lloyd, I'm Editor-in-Chief of Professional Advisor, and I'll be your host for the next hour. Before we get going with today's session, let me quickly run through the usual housekeeping. This session's being recorded, and we'll send you a link of the recording by tomorrow. Do feel free to share this with your colleagues. And as usual, today's working lunch will qualify for 1 hour of CPD. We'll be sending you proof of attendance along with the link to the recording of the session, which should arrive in your inboxes tomorrow. So let me just move on to our next slide. So now we're going to get on with our session today. Successful investing doesn't need to be complicated, but it does need to be balanced. Since 1987, Baillie Gifford's managed fund has combined equities for long-term growth with high-quality bonds for diversification, drawing on opportunities across asset classes, regions, and industries, harnessing multiple themes to drive results. In this session, we're going to be exploring the role of the US in global equity markets, why diversification remains essential in an increasingly uncertain world, and how bonds can help smooth returns, particularly during periods of heightened volatility. I'm delighted today to be joined by Stephen Hay. He's Head of Income Research and co-manager on Baillie Gifford's managed fund and newly launched Cautious managed fund. Do feel free to put your questions to Stephen using the chat function, which you'll find at the bottom of your screen. If you wish to remain anonymous, then simply select my name from the top drop-down box in the chat box and then type your message so only I can see it. Today, we're also going to be doing things a little bit differently because we're going to be launching a poll. So you should be able to see that in a moment. That will come up. And the question we're asking today around that big issue around concentration risk: what do the audience think is an appropriate weight for the US market in a global equity portfolio? So what do you think is an appropriate weight for the US market in a global equity portfolio? And the possible answers, we've got 70%, 50%, 30%, and 20%. So maybe have a look at that and do that now while I'm talking. I know Stephen's going to be discussing this issue more in his presentation, and we'll look at those poll results a little bit later. And just before I hand over to Stephen, I want to just go through our learning objectives for today, which are explore the factors that have led to US dominance, especially in global equity markets, understand the benefits of a globally diversified portfolio, and describe fixed income's role in smoothing returns. So that's the CPD covered. Just a reminder about the poll as well to do that, and we'll share the results later. But now let's hand over to Baillie Gifford's Stephen Hay. Afternoon, Stephen. Thanks very much for joining us.
Hi, Kat. Thank you. Yeah, so thanks for the introduction, and afternoon, everybody. I'm delighted you managed to switch off the Winter Olympics for a short while and come and watch this webinar. So hopefully this will be informative and useful, and it would be great to get some questions in at the end. So please do put your questions into the chat function. So what I'm going to kick off with today is to look at the global environment that we're in and think about where we've come from and where we're likely to go to. So if we think about where we've been over the last decade or so, it's really been a decade or a period of US exceptionalism. So that's been partly at least driven by the economic side of things. So economic growth in the US has been significantly stronger than in other regions, especially of the developed world. Partly that's been down to fiscal stimulus. So there's been very positive fiscal stimulus coming from both the first Trump administration and from the Biden administration. So there was definitely a government spending juice to that, but growth was significantly stronger in the US, and that attracted money to come into the US capital markets. On the bond side, you had higher interest rates because of that higher growth, and that attracted money to come into the bond market, and that helped to push the dollar up. You also had this period of exceptional US companies and US companies dominating the corporate landscape, and that led to inflows into the equity market as well, again pushing the dollar up to really quite strong levels. And this feeling that the rest of the world just wasn't at the races in terms of the growth engine that the US was exhibiting, and that led to increasing concentration in the US equity market, and then into particular a relatively small number of stocks, Mag 7, for example, as being that. So that was that has been the dominant narrative, and people have called the end of that narrative, quite a number of times over the last decade, but it has kept powering on. And what you can see in the chart here on the right is the performance of the US index relative to all the other main regional indices, and it's been a really strong period of outperformance over the period shown. And what it's led to, one of the things it's led to, as well as that concentration within the US equity market, has been is that overall valuations in the US are significantly more expensive, for very similar companies often, than in other parts of the world. So I think if we look at a forward price earnings ratio for the US, it would be around 22 at the moment, whereas the average for all the other regions is less than 15. So there's clearly been, there's that move in valuation is worth noting. And so this has been something that has been the dominant narrative for the last 10 years, as I say. But what we've begun to see last year is some fraying in that narrative. And I think one of the big questions, and there are many questions in people's minds, but one question is this the end of US exceptionalism, and will we see the promise from other regional markets, come home? Well, I think our take on this is that we do think things are changing. And just to give some color on this, there are, from the US side, things are a bit less exceptional than they were. So we've seen growth being really dominated by AI capex, and the rest of the US economy isn't really growing that fast. The consumer's fairly sluggish, really. Now we're not downbeat on growth in the US, but it's definitely been a bit of a step down in terms of the US growth narrative. And at the same time, you've had things like tariffs, which are messing about with the trade relationships the US has with different countries, and changing other countries' focus in terms of where they should be focusing their trade efforts. And then you've had, the dollar weakening significantly, and this is partly policy led. So there's been, I think, definitely been part of the Trump administration's aims to get the dollar down. And one of the ways they've done that has been to play a bit fast and loose with their credibility in the financial world, and that's meant they've been attacking the Fed. For example, they've been sacking the head of the Bureau of Labor Statistics, so messing about with some of the data sources. And some of this you can think of as being round the edges, and it's definitely part of the reason why the dollar's been weaker. And you've seen the US yield curve steepen, and those things have definitely been accelerated, if you like, by the actions of Trump and the Trump administration. And I think these things are quite credibility for institutions is very hard won, but quite easily lost. My first part of my career was spent at the Bank of England before the bank got independence, and we didn't have a lot of credibility at that time. You might argue we've since lost it, but at that time we were trying really hard to prove ourselves in lots of academic work, policy work. Mervyn King leading that, and eventually we got independence and got a degree of credibility. At least it's hard won, because it takes a long time for people to gain people's trust, and it can be easily lost. So there is definitely a risk premium on US assets that's begun to emerge because of what's happening with the Trump administration's aims. And it may remain in the realm of skirmishes around the edges for largely political points, but there is a danger that it goes a bit further than that. I think Trump has backed away from the worst moves with his appointment of Kim Warsh to head the Fed, but we shall see what Warsh turns up when he takes on the job, and what he actually does. So I think there's reasons from the US side of things to think that things are just a little bit less exceptional than they have been over the last decade. Meanwhile, on the other side of the pond, we've got real significant fiscal stimulus coming through in Europe, mainly in Germany, where you've got 25% of GDP worth of fiscal spend over 10 years. That's going to lift German GDP growth by about 1% every year. Now, bear in mind that German GDP growth has been negative, running for the last 2 years. This is significant that we're going to boost it by over a percentage point. And that, while it will mainly come through in infrastructure and defence spending, it will feed through to the rest of the economy and through to the rest of Europe. So while we by no means think that all Europe's problems are solved, this is probably the biggest, most significant policy shift in Europe that we've seen for a generation. So it really is worth paying attention to and thinking about what the impact could be of that. So for the first time for quite a long time, Europe, from a macro and from a growth perspective, really does look interesting. And then in Japan, I've all my investment career, Japan has been in deflation. And people have talked forever about whether it might finally end. And well, it has. Deflation has now ended in Japan. We're securely in positive inflation territory. And the rates market, the bond market, is beginning to normalize. So interest rates are going up. And there's a renewed vigor, if you like, about the Japanese economy, partly because there's a big fiscal stimulus that's coming. We've got a new prime minister, quite a change in the a female, not the old male guard. There's a bit more energy perhaps coming through. That fiscal stimulus will help that. And so Japan looks interesting from a macro point of view in a way that it hasn't done for quite some time. And then moving into the emerging market space. Emerging markets, a number of years ago, emerging markets were the answer to everything, and then they're just disappointed for many years. And part of that has been down to China concerns about Taiwan, issues with China, concern about the Communist Party cracking down on certain aspects of the economy, and that's put a bit of a negative spin on and sentiment towards aspects of investing in China. But more broadly, there's just been a bit of disappointment. The assets in emerging markets have been a bit unloved. But meanwhile, growth outcomes have been pretty good, and at the moment look very good. In particular, it's worth noting the amount of intra-emerging market trade there is now. So I think 40% of global trade is now intra-emerging markets. And so the idea or the days of it being that an EM is a cheap manufacturing location for exporting only to the developed world, that's no longer the case. There's an awful lot of trade going on within the emerging markets, and it's a more mature set of countries and opportunities than it was 10 or 15 years ago. So we see a lot of excitement and enthusiasm in that area of the world as well. So if you like, US exceptionalism coming down and the rest of the world pushing up towards it. So for us, it's a much more balanced picture globally than it's been for quite some time. And when you think about that valuation difference between the US and the rest of the world, then there's definitely something interesting to look at from our point of view. Now, one of the things that all those flows into the US over the last 10 years have led to, often going into passive funds, has been the weight of the US in the index has rose dramatically. Now, this is where I'm going to end the poll. So I hope you've got your answers in already. I'm going to end the poll now. See where the answers are. So I'm not sure if everybody can see those or not, but I have the largest. So for 70% in the US, so just for context, first of all, a global equity index now has about 70% in the US. It's moved up from 50-55 10 years ago. It's now 68, 70% is in the US. It hugely dominates the global equity index. Now, it looks like from the poll results, people think that's too much. So we've only got 17% think that 70% is appropriate. The largest weight in the poll is for 50%. So 43% think 50% is appropriate. And then we've got 32% think 30% appropriate. And the smallest number of all think 20% is appropriate. So I've got a bit of work to do here to persuade you, because we take a view within Baillie Gifford that within the managed fund and cautious managed fund, that the 70% is far too much. in the US. It's very unbalanced. It's a case of too many of your eggs in one basket. And we see lots of opportunities elsewhere in the world. So the way the managed fund and cautious managed fund, the way their equities are divided is to be much more balanced, with roughly equal weights between the US, Europe, the UK, and the Asia and EM as one block together. So roughly equal weights between those four regions. So just under 20% in the US. So I've got to persuade some of you that that's appropriate. Now for us, I mean, this has been a little bit of a headwind for the managed fund over the last few years, as you can imagine from the performance of the US. But we feel from here, given where valuations are, and given the reasons that I've talked about for why from a macro point of view, the US exceptionalism is coming to an end, not least also the risks to do with AI concentration in the US. Now it's going to be a real tailwind for the managed fund and cautious managed fund to have a much more balanced regional allocation to global equities. Now, we've got teams that have been looking at these different regional markets for many years now. And so the managed fund has over 200 equity holdings across these different regional portfolios. We manage these funds on a silo basis, so they are the best of our regional teams' portfolios coming together into a broad, balanced portfolio. And just to give you a flavour for the global nature of this portfolio, you can see we've over 200 stocks. Pick out things like, for example, Keyence. I mentioned Japan, how Japan's exciting at the moment, and there's definitely something going on. So Keyence is a leading global robotics player, but it's very tapped into what's happening in Japanese manufacturing, and so really well placed to benefit from not only the growth of robotics globally, but also from a bit of a renaissance in terms of Japanese nominal growth. Meanwhile, in South America, Mercado Libre, for example, it's like the Amazon of South America, and that's a holding we've liked for some time and think it's got great growth opportunities there. If I may just focus a little bit more on a couple of names, just to give you a flavour of the types of things we have in our portfolios. As you know, Baillie Gifford will look for stocks that can grow their earnings faster than the index. We've got a very strong belief that if you can find the companies that grow their earnings faster than the index, then you will outperform that index over time. And that's what the historical record shows us. Not over every short-term time period, but over longer periods, that has been proven to be the case. So looking for companies that have a really interesting, good growth profile, better than the market. One of those is found in China. It's called Meituan. And you can think of it as China's local services super app, if you like. It first made its name in food delivery, where it has over 2/3 of the market in China, but it's been expanding into other areas, including groceries, including in-restaurant dining, other forms of travel, etc. And one of my favorite anecdotes is one of my colleagues, Ben Buckler, went out to Shanghai to meet a client, and he was struggling with jet lag, and as Ben likes to do, he thought a melatonin drink would be the thing that would sort his jet lag out. So he went onto Meituan and ordered a melatonin drink, and it arrived to his hotel in 15 minutes by drone, which he was, and I've been suitably impressed by, as the kind of things that this company is able to do. This company is also, as I mentioned earlier, about intra-EM trade. So this company is expanding fast into other countries, and it's nearly #1 in South Africa, UAE, Saudi Arabia, and a host of other emerging market countries. So we really like it because it's got a great structural growth story. It trades significantly cheaper than what you might think of it as an equivalent in the US, DoorDash being a food delivery company in the US, which we really like, but DoorDash trades at a price earnings multiple way higher than Meituan. And so Meituan is a much better way to access what we think is a great structural growth story in China. And then we like to highlight that growth comes in all sorts of shapes and sizes. So people might think that Baillie Gifford are investing in tech all the time. We have been known for having exposure to tech companies. But it's absolutely not the case in a fund like the managed fund. There's all different types of growth. We are agnostic about where the growth can come from, and we're very open-minded about where it might come from. And companies like Marks and Spencers and Greggs have been in the portfolio successfully over the last few years. Another one where growth comes in completely different size is Games Workshop. Now, this is the company that produces the fantasy miniature figures, and it's been well known for its Warhammer stores, which are in 24 different countries around the world. And my colleague Ian McCombie, who runs our UK equity portfolio and is a big fan of this stock, describes it as one of the UK success stories. He said when everyone's downbeat about what the UK can do, the Games Workshop is an example that shows that good stuff does happen in the UK. It's a bit of a manufacturing colossus. It's got intellectual property it's developing, which is really strong. We like the management. The management are very straightforward, and one thing that's really important to us is that they are very focused on the long term. So we're aligned with them in terms of what we're looking for, in terms of how they're planning, in terms of how they're investing, etc. But they're still, even at the moment, they're very profitable. So they have a higher profit margin than Google, which is fairly impressive. And I think we think it's a great long-term growth story, as there's plenty of these fantasy modelers about the place, and it's growing. But they've got a kicker recently of having a tie-up with Amazon to make a series of TV programs based on the Warhammer characters, and so extending their intellectual property, and we think that'll be a really positive development for the stock. So lots of different exciting growth ideas that we've liked for quite a long time in different markets, but we see their time is coming in terms of the bigger macro shift, and when the fact that the market will start to take notice of more of these great growth stories. Now, I'm sorry to bring him into this at this stage, but we know that if we have a portfolio with some, with interesting growth equity stories, you'll see periods of volatility in those share prices. That's just the nature of markets. One such example was Liberation Day last year, when Trump got his notice board out and showed everyone what the tariffs were going to be. The market reaction at the time was quite significant. You saw a big sell-off in global equities, as you can see in the chart on the right. So the darker line is the global equity index. Significant sell-off as people were really trying to work out, well, what does this mean for the future of trading relationships? And could growth be significantly hit? Will we go into recession, etc.? And at times like that, it really helps to have balance in the portfolio. So you can see what bonds did over that period. So the lighter blue line shows that bonds sailed on through, in fact, did actually rallied during that period. So provided a good degree of diversification and not perfect correlation. So this is why we have bonds in the managed fund and in our cautious managed fund. It's to provide some diversification against what's happening in the equity market. And we know also that our bonds are about a third as volatile as our equities. And therefore we can tell from that we will be providing that overall, by having an allocation to bonds, then we will have, that will be bringing down the volatility in the fund. Now, in terms of how we actually go about managing the bonds in the portfolio, it's certainly not a case of an allocation to gilts or investment grade credit, and that's it, and we leave it there. We are very active in our bond portfolio as well as our equity portfolio. So we're looking for an active return to come from each bond. We are return seeking in what we're trying to do. Our portfolio is, we have a diverse range of bonds in the portfolio to help us get that diversification across the portfolio, different types of bonds. So we have roughly about half and half between government bonds and between corporate bonds. And within the government bonds, we have most of the portfolio in developed markets, in the likes of the US, the UK, Europe, etc., and their bond markets, but also a sizable allocation to emerging markets, where we often see the best opportunities, where yields are higher, where there's a more interesting turnaround story, or where there's something that the market isn't quite getting. We have a global bond team that will be actively thinking about the duration that we should have in the bond portfolio and think about how bullish or bearish we are on bonds, whether as a few years ago when we saw inflation picking up significantly and interest rates rising to be reduce that duration. And then vice versa, if we think inflation is coming down and rates are going to come down to get longer duration, as we have been for the last year or so. So that team's thinking about that and thinking very carefully about which bond markets or which bond issuers to lend to, which governments are safe to lend to, which ones are going to have trust moments and which aren't, or which ones are more reliable. And then the corporate bond side, as you'd expect from Baillie Gifford, it's very much for us about just knowing our companies really well. So just picking those bond issuers that we think the market's not appreciating something. So for example, there might be a company's bond that has a higher yield than we think is appropriate for the risks. And then therefore we can buy the bonds hoping for those yields to come down. And that gives us an extra return versus the index. Or there might be a capital event coming around due to some things happening within that company that we think can lead to a capital gain for that bond portfolio. So that's what we're looking for in our corporate bond portfolio. Again, 2/3 of that is within the investment grade universe, solidly investment grade, and about 1/3 is within high yield. So overall, over that, the whole bond portfolio will be BBB in terms of rating, with a duration round about 6 and a yield of 6 to 6.5 on that portfolio, which significantly out yields the bond benchmark, global bond benchmark of 4.5. And lastly, in what we're doing with our bond portfolio, just to make sure that we are doing a proper hedging job or diversification job, bringing the balance for the rest of the portfolio, we have a limit on the beta of the bond portfolio to our equities. So the beta has to be less than 1/4 to our equity portfolio. Otherwise, we judge that it's not providing enough of that balance and diversification that we want for that job. So I mentioned that as with the equities, we are completely global in outlook. So we are not constrained to the UK or any other geography, and we're really looking globally for where the best ideas might be within bonds. And just to pick a few to give you a flavour, again, you'll see Peru there. So within emerging markets, Peru is one of the ones we like the best. So yield 6 or 7% in Peru, and yet inflation is very well contained. So we've got a real yield, so the yield after inflation of over 4% in Peru. So that compares very attractively with the likes of the UK or the US. Peru's institutions are really well managed. They've got loads of FX reserves, so the currency remains very stable. And they've got a good policy framework, and they've got the kicker at the moment of being one of the world's biggest copper producers. And the copper price is on a tear, and we think that the structural demand for copper is extremely strong. So this is something that really will help Peru over the longer run. So these are bonds that are paying a much higher yield than we can get from other developed market sovereigns, but we think in many ways are lower risk. So that would be the type of thing that we are looking for in this portfolio. Again, brings the diversification in there. On the corporate side, one example would be Mitchells and Butlers, which is the UK pub and restaurant chain. And Mitchells and Butlers, one thing we like is the fact that it's written into their covenants that they have to use spare cash flow to pay down the debt, which strengthens the balance sheet over time. And we think there'll be a refinancing at some point soon, which will allow us to crystallize the gains for bondholders like us. So that's where we're looking for. And meanwhile, we earn a nice yield of 6 to 7%. So that's just an example there of the kinds of things that we're doing within the corporate bond portfolio. And the important thing is it's bringing some balance to the overall equity or the overall portfolio and diversification to what the equities are doing. So just before I get to introduce our cautious managed fund, just a very quick reminder about our managed fund. So many of you may already know our managed fund. It's been around, as Kat said, since 1987. It's been through many market cycles over that period and significantly outperformed the index net of fees over that, on the peer group over time net of fees. As Kat says in the introduction, what we're about at Baillie Gifford is trying to keep investing as simple as possible. We think investing can be very complicated. Lots of things you could think about. We try and keep it really simple and keep our investors focused on not the short-term noise, but just finding In equities, finding those companies that can grow their earnings faster than the index, and in the bonds, finding companies that are offering something the market's not appreciating in terms of those yields. So just really trying to keep it simple. It's been broadly the same process since the fund was launched in 1987. It's been just evolving. It's a silo-based strategy, so it's actually one of the broadest strategy within Baillie Gifford. So it's got the most number of different teams within Baillie Gifford feeding in to this overall portfolio, and myself and my colleague Ian McCombie from the UK equity side, we are the name managers bringing all that together. We've been working together for over 12 years now, doing the management of the managed fund. So if you like, we like to describe it as like a one-stop shop for the best at Baillie Gifford. But over the last few years, we've had some feedback from clients and from IFAs and other advisors that they've got appetite for something that is a little bit less volatile than the managed fund. The managed fund has 75% in equity, so that's the real driver of returns in this portfolio, with a 25% in bonds and cash for some balance and diversification. But a feeling from feedback that people would like something that was just a bit more of a smoother ride, if you like, for some clients that are maybe looking to de-risk a bit. And so we've listened to that feedback, and we have launched the Cautious Managed Fund. Now, the Cautious Managed Fund, because people said they want exactly the same process, the same people, just a different degree of volatility. So that's what Cautious is. So it's exactly the same team, it's exactly the same process, it's the same underlying holdings, it's just a different starting asset allocation mix. So rather than the 75-25, it's 50-50 between equities and bonds and cash. And so that's the way you should get a lower volatility number coming through. But we still feel it's really important that an investor who wants to have a cautious managed fund, something in that sector, still gets access to the best global growth stories in equities. So that's what we've got in here. It's the same equities that are in the managed fund, just they're dialed down so they'll be a smaller size in the overall portfolio, but they're still there and still a really important part of the overall return. Now, just looking at, as the kind of proof statement, if you like, looking at this is the managed fund performance versus the peer group, 40 to 85% peer group. So the managed fund is a dynamic planner rated 7 fund, cautious managed. What we're able to do, because cautious managed has exactly the same building blocks, just that different asset allocation mix, we're able to simulate the performance what it would have been over the same period. And as you can see, it's dynamic planner 5, it's against the 20 to 60 peer group, but it would also have significantly outperformed that peer group over this period. Now, people who hold the managed fund already will know that for a fully actively managed fund, we already sit at a fairly attractive fee level, 41 basis points. But the good news for cautious managed, for the excitement about the launch, is that we are reducing the fee on cautious managed for 3 years from launch date, and it will be reduced by 30% relative to managed funds. So we sit, even including passive funds, we sit at a very attractive overall fee level. So, we hope that, I'm sure we'll go into this in Q&A, but in terms of how we're seeing the world, we think there's too much of your eggs in one basket from an equity index that has, the kind of exposure to the US that passive funds will have of the 68 to 70%. That's just too much of your eggs. We think there are good reasons why the US won't perform as well for the next 10 years relative to other markets. We see lots of opportunities in those markets. I think we want to have a lot of exposure to them, and that's what you get in the managed fund and the cautious managed fund. And we're now offering clients that degree of choice. So if the managed fund is a little bit too volatile for you, then the cautious fund offers you a nice alternative, and we think they're great value for investors. So I'm going to stop there and go back to Kat, and then see where we are with Q&A.
Great, thank you so much for that, Stephen. And just a reminder, you can still keep putting your questions, and I'll put those forward for Stephen. Again, put them in the box, please. And thank you for completing the poll. Just sticking with the US theme, that's one of the questions we've got through here, Stephen. I know you mentioned it in the presentation, but the question is, what do you think will happen with the American market this year? I know you touched on that, and we're looking about a longer term view, but early in the year, but lots happened already. Yeah, how would you sort of respond to that question?
Yeah, the bigger point would point to what I've been talking about, which is the fact that we think other markets can outperform. So what you saw that last year, so many markets outperformed the US last year, and part of it was the weaker dollar. We think that'll continue. We think the dollar will continue to weaken. We think other markets, there's still a huge amount to go. So although they did perform well last year, and some of them outperformed the US, the valuations haven't really changed. So that it still looks incredibly attractive to be in those markets. And we think that the flow, the mood music is moving a bit away from the US, because I think people realize it's a fairly concentrated bet. What I would say is, though, that this is not to say by at all that we think there are not fantastic companies in the US. We think there's some amazing companies in the US and lots of excitement about those, and we have 50 of them in the portfolio. So we think there's some great opportunities in the US selectively, but it's just we don't think it's appropriate to have such a big weight as many funds and many portfolios do in the US. We think it's better to have a more balanced regional approach.
Yeah, it's a big decision, isn't it? It's a big topic of conversation. Definitely was last year and coming into this year around that US weighting. As you say, there's been times when we think it's moved elsewhere, and yet the US still has another great year, which can obviously be a headwind if you're underweight. But I presume it's something you're constantly sort of reviewing and looking at. But it is difficult when you've got such a high percentage to the US in the benchmark weighting.
It is something that is challenging, and that has been a bit of a challenge for us over the last few years. We can vary it. We can change the asset allocation, so we can move it about if we felt it was something that we felt very strongly about, that we should have much more in the US, and we're at one of our lowest points at the moment for that. So we have had overweights to the US in the past, and we can do again, and we do keep that under review. I would say this is one of the strongest views we've had for over a number of years, that actually this is the beginning. Last year was the beginning of a trend that will continue for quite some time, with the US not being the standout performer, albeit, as I said, there are some great companies there, and you do want to have some exposure there.
Yeah. Let's talk about AI, and let's talk about the other big topic around that, concerns recently about the spending levels of companies on AI and what that could mean. And also we saw the sell-off in software names a little earlier in the year as well. What's your thinking around this whole question coming into this year? And I suppose particularly how it impacts some of your names in the portfolio, and that when you look at their spending levels on this, are you concerned or?
I don't think there's a huge degree of concern, as in we think this is unsustainable necessarily, this degree of spending. It's coming from a position of strength, so a lot of it is funded out of cash flow, which gives you a lot more or more reassurance about it than if it was all borrowed money. And it feels like the scale of this change and the speed with which it's happening does justify huge amounts of spending. No one knows what the right number is, and of course these may be overestimates, but I don't think there's a feeling across the board that there's definitely too much spending on there. So one people are watching very carefully. I think maybe where more of our time is spent is thinking about who will be the beneficiaries of that. And the SaaSpocalypse, as people are calling it, in terms of the software as a service sell-off over the last few weeks, has been certainly interesting to think about where that's going to go next. I mean, for those that haven't been following it so closely, I mean, it was kind of precipitated by, well, I suppose maybe valuations in a lot of stocks running up to levels that were fairly goey, which is kind of my point about the US market, although it's not exclusively the US. But the catalyst for the sell-off was Claude and Anthropic releasing details of its co-work which was kind of written almost entirely by its coding, Claude Code, its coding machine LLM, and the interfaces that it was, or agentic interfaces it was releasing open source for the likes of legal work to be able to read contracts, etc. And this led to a market kind of realization is maybe too strong, but certainly a market fear that, whoa, huge big swathes of software as a service companies may not exist, may not have much of a competitive moat at all. And this is true of not just of those companies. It's really not just software as a service. It's more just all digital, any company that has digital output, digital goods and services. So we are thinking extremely hard about how the world looks and will change in the future. So one thing that I think Baillie Gifford does do, or does pretty well, is look further ahead to try and think 5 and 10 years in the future. We have a long-term holding mindset, and so we're not looking for the next bit of news headlines, etc. We are really thinking about how things will change and thinking deeply. And one of the things we really try and do is get different sources of information. So we try and be different from the crowd and think about how these things might move. I mean, we're actually big users of AI ourselves. I think we were from OpenAI's. We're the top 1% of users on their apps. So we've been using AI quite significantly for the last year or two, at least within our operationally within the firm, but also within our investment teams and processes to try and get better and think how to use it. So from the very top of the firm, there's been an acceptance from quite an early stage that this is a game changer, and we need to get ahead of it and think about how it's going to change things. I mean, we're thinking hard about which companies can do well. I mean, some companies we like, Snowflake and Datadog, which are very right at the vanguard of AI usage and data, but they've been hit pretty hard by this. So it's been, we are certainly challenging ourselves to think about where those companies and other companies' protective moat, if you like, is. It might be about data. If they own the data, then the AI LLMs can't necessarily take away their unique value, or maybe something about their process or something else that allows them to still have a business even if AI proceeds. So we're thinking extremely hard about it, but it is challenging because there's so much uncertainty, and the sell-off's been fairly indiscriminate. So there's undoubtedly been some companies that have been thrown out with the bathwater, if you like, as people rush towards physical assets, physical things that can't be AI'd away. And that's understandable, but that's the challenge for us as investors. And so we're using AI to help us, but we also use a bunch of other different inputs. We talk a lot with people in academia because they've got a different view of things, and we try and get what we call uncommon inputs to try and get a different view of how the world is changing. And ultimately, what investors want is not just, I think, not just holdings that are in the index, because that represents things that have been successful up to this point. They want the companies of the future, and that requires you to think very hard about which companies are best placed to protect their value creation and will be in demand in the future. So that's what we're thinking very hard about.
Yeah, you're right, isn't it? It must be challenging even thinking of that, especially even more in maybe the long-term view that over the next 10 years, because in the era of AI, it's happening so quickly. No one can really say exactly what's going to happen. There's new disruptors coming in all the time. It is challenging.
Yeah. And I think what challenging for as a fund manager, I mean, some of the wealth management companies were sold down quite heavily
Yeah.
So as part of this move from Claude Cowork. But we have to think carefully. I mean, it used to be that information was something that fund managers had, that an advantage in terms of information, and the internet took away that. It basically democratized information largely. What AI is doing is giving you knowledge in abundance. So knowledge is no longer something that fund managers can say, I've got the knowledge of how this behaves or how this works, because the knowledge is there for everybody. And so you're left with, well, what's left? What are the humans bringing to the job? And it is those things about wisdom. It's about curiosity, imagination, judgment, those things. So for us, we're in some way having to rethink how we do the job. We're obviously still very focused on the task. I said about keeping it simple, finding the best companies, and that's all we do at Baillie Gifford. But how we go about the task on a personal level, and how teams work and so forth, is something we're continuing will continue to evolve. And it's up to us. Challenge for us is to make sure we use AI in the best way possible to make us the best decision makers we can be, and don't spend our time, doing stuff that can be done by AI just as well.
Yeah. Let's move on to talk a bit about the construction of the funds and the balance of the funds. Maybe you can talk a little bit more about what you're seeing in terms of correlations between equities and bonds, maybe over the last few years on the fund. I mean, obviously we had that year 2022, extremely tough and challenging year for investors, including in multi-asset portfolios. But where are we now in terms of you looking at that?
Well, the first thing I would say is that I put up the chart of the bond equity correlation, or how they moved during Liberation Day, and obviously bonds did move quite differently to equities. And people might say, but a couple of years ago they didn't. They moved exactly the same, and they didn't hedge at all. We've had a good long look at how bonds and equities have performed against each other through all the different crises, going back to the earliest bit of the 90s that we've got proper data for. And the episode in 2022 was the only one that bonds moved the same way as equities. So in all the other crisis episodes or significant equity drawdown episodes, bonds have acted as a really good hedge for them. So I would say to people that do not use the 2022 example as something of the likely normal behavior of bonds versus equities. So all the other evidence would show you that bonds act as a good hedge for equities, and that's why we have that's how we use them in the portfolio. In fact, they're the best hedge relative to gold or infrastructure or property, or those things. They are clearly the best hedge. What's interesting is to think why 2022 didn't work, and I think it picks up something where the situation where bonds won't be a good hedge is essentially where you see when real rates have been low, as they were before we started that point. It would be negative in the UK, for example, and when you see inflation hit. In that situation, bonds will react negatively and that will be the cause of the shock, if you like, the cause of the shock to equities. And so that's the one situation where they won't work as a good hedge for equities. So, and if we go back to the 70s, that would also be the case. So I think the evidence would clearly be that bonds are a good hedge for equities in the long run, and we shouldn't be dissuaded from that or overly biased. And we're always biased by the most recent episode. That's the problem. And it was such a big move. So that's going to be the thing that sticks in everyone's mind because of recency bias. But I would urge people to understand that the bonds over the longer run, over lots of different crises and episodes, bonds have acted as a really good hedge for equities.
I was going to ask you about resilience. What did you learn from that 2022 period in terms of resilience of the portfolio, trying to control drawdowns? What sort of changes did you make since then?
Yeah, as I said, we're basically employing the same process as we have all the time, looking for those great growth companies and bringing them into the portfolio in a balanced way. So and we think the worst thing a fund manager can do can change their style. So we are a growth manager. That's how we manage portfolios, and people should always expect that from us. That being said, we can always look at how we've done and look to see if we can improve and if we could have improved on outcomes. And it was true over that period that we had maybe a slightly higher weighting in the portfolio in names that were not as resilient as we would have liked. So ones where they maybe weren't currently profitable, and we saw profitability come further down the road. So I think at that point, at the lowest point, we maybe had 75% of the companies in the portfolio were currently profitable, and the rest were looking to be profitable in the future. That number's up to 95% now currently profitable. So that we've improved the resilience of the portfolio and taken that on board. I think given there's more volatility out there, the market is more prone to big swings at the moment. So just I think looking for stress testing our investment cases, making sure that process is robust, and we tightened up a few things there. But broadly speaking, just trying to implement our bigger aims and processes better than maybe we had.
Yeah, I'm just conscious of time. We've got a few minutes left. I just wanted to touch on a couple of big issues that we've seen this year. Maybe you can say a little bit about your UK exposure within the fund. And obviously, we've seen in the last few days, Starmer, the Prime Minister, has survived for now, but there was obviously issues there for him to tackle and on an ongoing basis. So maybe you could say a little bit about the UK weighting, and then we'll talk a little bit about maybe UK and US rate expectations. But yeah, maybe just say a little bit about your UK thoughts at the moment.
Yeah, well, I mean, the first thing to say is always is that the UK market has, and the equities we hold within the UK are very global. So they are it's one of the most global equity markets. So there's most of the big companies in the UK are outwardly focused and earn much of their revenues from overseas. So what actually happens in the UK domestic economy isn't super important for them. So that's one point to make. Another point to make is that I'm actually, and my colleague Ian is not as negative in the UK as a lot of other people. We think there's been a lot of negative news over the last few years, and I think the absence of negative news will actually prove to be quite positive for the UK. We've got a pretty robust global growth picture looking forward, which I referred to earlier. I didn't pick out the UK as being a particular bright spot, because the other ones there's individual things you can point to that have changed in those other markets. It's really positive. In the UK, that's not the case. I think for the UK, it's more because it will benefit as a very open economy. It will benefit from Europe doing better, for example, and it'll benefit from global trade and global growth being quite robust. So that's a positive environment. I think inflation is coming down. We come on to this with the rates view, but inflation is coming down. I think having had all the hoo-ha about the budget last year, I think just not talking about it in the absence of that kind of negative news, if we have reached a point now where we can, right, Starmer's in place for a period, let's just not talk about it for a while. I think people will see there's actually some green shoots in the UK economy, and it's looking not too bad. So I wouldn't be too much of a doomsayer on that, but it's with the proviso that a lot of our UK holdings on the equity side are not actually that affected by the UK economy.
Yeah. Well, let's just quickly talk about sort of rate expectations. And you mentioned during the presentation the nominee of the new chair for the Fed, which got markets busy and trying to work out what that would mean. What was your sort of take been on that?
Yeah, so as I mentioned in my comments earlier, I think there's still challenges for the Fed. I mean, Warsh wasn't the worst appointment from that point of view, from the market's point of view, but still, let's wait and see how influenced he turns out to be in the end. I think there's a huge amount of debt out there in the US, in the UK, in Japan. So there are bond markets are more volatile than they have been in the past. So you don't have as many people wanting to buy long bonds as you used to. So you've seen yield curves steepen, and that's partly because of that demand supply of long bonds, but also because people are a little bit wary about where the supply is going, how much fiscal stimulus there will be, and where inflation will be if the central bank plays a bit fast and loose with it. So I think we probably see that continue. I think we see yield curves continuing to steepen a bit. That's the bias here, which means longer dated yields, not falling or as fast as the short dated ones, or maybe even rising. Overall, pretty dovish in inflation. That would be our view. I think AI is very disinflationary, and I think we'll see that come through. I think the labour markets will be a little bit weak. That'll be the one weak spot in the global economy. But lower inflation plus a kind of weaker labour market and pressure on wages, I think will mean central banks can be fairly dovish. We've seen the Bank of England be quite dovish, and I think that will continue. I think we'll see rate cuts come in the UK, perhaps more than is priced in. So maybe 2 to 3 this year. I think the US will probably still do 1 or 2 cuts, even though it's maybe not justified.
Okay, I'm conscious of time, so just before we finish, Stephen, maybe just give us your final thoughts, maybe about why investors should be looking at these sort of strategies now? You mentioned quite a lot of different points in your presentation, but yeah, what's kind of key for you?
Yeah, I think there's a huge amount of risks of being concentrated in the US at the moment. We see lots of opportunities in other markets with good valuations. So this, I think, now's a great time. We know that some growth companies in general have had a tough time for the last year or two. It's, you know, values done very well. Growth companies operationally are doing well, just that the market hasn't wanted them at the moment, and these market sentiments do change. And so we think growth is a great time to buy growth. So we think it's a good time to buy Baillie Gifford funds, and in particular in a balanced format. You get the diversification of the bonds coming in there to give you a smoother ride, and it's exciting for us to have a range now. We've this is the managed fund for many years, and it's like you can't accuse us of launching a sequel. It's almost been like a difficult second album. We've taken us a while to get out there with our second series, and it's really a choice now for clients. It's a range of managed and cautious, which give them options. So we're really excited about that. So yeah, I hope people think likewise.
Great. We did have a more technical question, just asking how someone can access data around the fund. What we'll do is send that over to Baillie Gifford, and hopefully someone from the team can just get back to them on that. But I'm sure any other questions you may have for the team, please do contact Baillie Gifford on that, and they'll get back to you. But thanks so much for joining us on that, Stephen. Really interesting to get your views at the start of what promises to be another eventful year. Just before we wrap up, we're going to take a look at those learning objectives again. I'll just move my slide along. Get them up on the screen. There we go. So learning objectives, we're exploring the factors that have led to US dominance, especially in global equity markets, understand the benefits of a globally diversified portfolio, and describe fixed income's role in smoothing returns. Just to remind you that CPD should be delivered tomorrow for this session. But just before we close, I just want to give you a bit of a teaser of some more PE professional advisor events that are coming up in the next few months. So on the 18th of March, we're going to be at the Brewery in London. That's our annual Professional Advisor Awards. We'll be celebrating the best in the industry. Good luck to any of you who are shortlisted for an award. The following day, we have our next working lunch. That's with L&G. It's called Beyond the Horizon, Navigating the New Landscape of Retirement Solutions. We're going to be joined by L&G's Nick Birdseye, Georgia Perkins, and Joanne Cohen. Then on the 25th of March, we're going to be joined again by Baillie Gifford for another working lunch. This time we're going to be talking about US growth, what really matters, and we'll be joined by Ben James. He's an investment specialist on Baillie Gifford's American Fund. Then on the 23rd of April, we've got our annual PA 360 conference in the city. This is now firmly established as the UK's largest annual management conference for advisors. We've got over 40 speakers during the day. They're going to be covering everything from regulation, tax, estate planning, technology, outsourcing, and investment. And the day will be rounded off with a keynote presentation from ITV's Robert Peston. So all in all, that's a total of 8 hours of CPD over the next couple of months. And as ever, if you wish to find information on or sign up to any of our events, you can do so by visiting professionaladvisor.com/events. That's all today for us from this session. Thanks so much again, Stephen, for joining us, taking our questions. And thank you very much for joining us this lunchtime. We hope you found this session helpful, and we hope to see you at another Professional Advisor event very soon.